Ryan Zupan here with the Mortgage Center Citywide. Last week we explained what is a variable rate mortgage. This week we're going to go one step further back and explain where this variable rate comes from. Whenever you go with a variable rate, you're opening your mortgage up to a lot more risk than, say, with a fixed rate mortgage. Because your interest rate changes throughout the term, there's really no limit to how high this rate could go. So it's very important that you understand who or what controls this rate and how you can get an idea of where this interest rate is likely to go while you have your mortgage. Remember, your variable rate is tied to the bank's prime rate. So the question we have here is, what determines prime rate? Well, prime rate's controlled by the Bank of Canada's target for the overnight rate. They are directly related. When one increases, so does the other. The Bank of Canada announces 8 times a year whether it will increase, decrease, or leave that rate unchanged. This is a very important announcement for those who have lines of credit or variable rate mortgages, because this is going to tell you what's going to happen to your loan over the next month or two. So why would the Bank of Canada change the target for the overnight rate and in turn prime rate? Well, this is really a tool that the Bank of Canada uses to control the economy. When the economy is strong, the price of goods starts to increase and inflation starts to happen. So to try and slow down the economy, to curb inflation, the Bank of Canada will raise this interest rate. When interest rates are higher, it's more expensive to borrow. So there's less incentive for me to go and take out a loan or purchase a house or whatever. When it's more expensive to borrow, you can expect less borrowing to happen. On the other side of the coin, when the economy is poor, for example, the end of 2007, the Great Recession, the Bank of Canada lowered this interest rate. They wanted to encourage borrowing. They wanted to give the economy some kind of kickstart, some kind of stimulus. So they made borrowing very cheap. They lowered this rate. When borrowing is less expensive, I'm more likely to go take out that business loan. I'm more likely to go buy a house. If enough people start doing this, then the economy is going to start going on an uptrend. It's going to be back on the right track. So with your variable rate mortgage, prime rate is not some magical number the bank uses to control supply and demand. This is a number that's controlled by the Bank of Canada and is based on the economy, on inflation. So if you'd like more information on this topic, or you'd like to know where the big banks economists are predicting prime rate to go over the next 2 years, contact me. I'm Ryan with the Mortgage Center Citywide.